evening, everyone. You're watching ET Now, and this is the Money Show, the only one-of-a-kind show, the India's first and the only one which brings financial markets experts to answer all your questions and queries and concerns with respect to your finances and your investments. I'm Karunya Rao, and we have a really special theme planned for all our viewers today. We have a very special guest as well, Harshvardhan Roongta, CFP Roongta Securities, joining us right here on the show today to discuss and deliberate a lot of ways in which all our viewers can save some extra bucks. Now, today's theme would be about those expenses which can actually make you save your taxes or get some kind of a waiver when it comes to your taxable income. Now, most people are aware that they can save tax under Section 80C, they could invest in PPFs, they could invest in ELSS schemes or even an insurance. However, what you need to be aware of is that there are certain expenditures as well which are permitted under a couple of sections. 80C, which is the main one of the Income Tax Act, which can help you save tax too. So let me not do all the talking. I'll also go across to Harshvardhan to give us a glimpse, a better picture of what are the ways to save taxes by increasing your expenses. That sounds like a very contradictory statement though, but give us some insights into that.
So, well, Karunya, there are a couple of expenses that you incur in your day-to-day living which can be used and under different sections and save tax on it. So, as you rightly mentioned, there are certain investments that you can make and save tax. So, this is another area that we will talk about today, wherein only expenditures are qualifying for deductions under different sections. So, of course, let's start with Section 80D. I mean, this is the first and the foremost section that you would want to consider, looking at the fact that the premiums that you pay towards your Mediclaim policies is qualifying under Section 80D. So, let's just understand this a little bit. So, the premiums that you pay for yourself, for your spouse and dependents are qualifying for deduction under Section 80D. And if you have senior citizens, I mean, if you have parents whom you are paying for and they are senior citizens, then that premium can also be paid and you can take the tax benefits under Section 80D. So, the limits, if you are up to age 60 years, the total premium that you pay is 25,000 rupees, and that qualifies up to 25,000 rupees. If you have parents who are senior citizens, then 50,000 additionally can be paid and you can save tax. Within this section itself, within this limit of 25,000 rupees, there is a small subsection of 5,000 rupees that you can incur, the expense that you incur towards a preventive health checkup. So, hypothetically, you spent about say 20,000 rupees towards the premiums and 5,000 towards preventive health checkup. So, 25,000 cumulatively is allowed as deduction. In case you spend 25,000 for premium and 5,000 additionally towards this particular medical test, then you cannot take the benefit of 30,000. So, it is 25,000. So, this is what under Section 80D, what you could do under that. Interestingly, if for senior citizens who are 60 years and above, in case they do not have a Mediclaim policy, so there is this provision available wherein any expenses that you incur towards the medical treatments taken or medicines that you bought as an OPD consultation, all those expenses up to 50,000 rupees can be claimed under Section 80D, provided you have made payments of these through check, through non-cash rather. You could use a credit card, you could use a check. So that's the underlying catch here, that if you bought medicines, first of all, you should be a senior citizen, you should not have any Mediclaim policy. And then if you've incurred expenses towards medical treatments, then you can claim the expense under Section 80D, provided you've paid it through non-cash modes. So this is a very interesting area where most of the senior citizens can take the benefit if they don't have a Mediclaim policy. We've spoken, you mentioned 80C being the primary area, and then most of the investors have their eye on 80C. So, well, yes, besides the investments that you make under Section 80C, there are certain expenses that you can that you incur and qualify for deduction under Section 80C. So, the first one being, of course, the expenses towards your school, your children's school fees. So, if you pay the tuition fees for your school, and up to 2 children qualify for deduction under Section 80C. So, the fees that you pay for your children towards their school fees can be qualifying as a deduction. The other one is, of course, the registration and stamp duty charges that you pay for your residential property. So, in case you have a residential property, you've just got it registered, so the expenses that you incur towards registration and stamp duty, that qualifies for deduction under 80C. I would also put term plan into this category of 80C because it's not a savings oriented policy. So, if you bought an insurance policy which has a savings element or endowment or a whole life kind of a policy, that is an investment. Term plan is an expense, so I'm putting it under this category. You buy a term plan which is essential for your financial planning purposes, and the cost that you pay towards this, you don't get back anything in case nothing happens to you. So that's an expense in that sense, and that qualifies for deduction under section 80C. If you were to go ahead and look at the home loans and the interest that you pay on home loans, so in case you're paying an interest on your housing loan, so that qualifies for deduction up to 2 lakh rupees under section 24. So that's another area that you may want to tap into. There are two interesting sections which need a mention, which is section 80DD. So it's an 80DD. Now this is this is allowed as deduction for medical expenses when you spend on yourself or dependents who have certain disabilities. So that could be cognitive or severe mental disabilities, blindness, for example, mental illnesses. So these are those defined disabilities. In case there is a disability and there is some expenditure that you're incurring towards the maintenance of for yourself or dependents who are dependent on you with certain disabilities, then there is a deduction available. Where if there the disability is more between 40%, it's above 40% but less than 80%, the fixed deduction that you are allowed is 75,000 rupees.
Right.
And in case there is a severe disability of 80% and more, then there is a fixed deduction of 1,25,000 that is allowed.
Just would like to intervene at that point. You've really opened up a Pandora's box there. There's so many ways, there's so many sections and subsections through which people can actually save up on their taxes or reduce their taxable income. But tell us, are they only, the ones that you stated, are they only applicable only for individuals, or can businesses and entrepreneurs can also benefit from them, or are there separate sections or separate routes through which they can also get a waiver on their taxable income?
Okay, so all the essential, all these sections that we've currently spoken about are more so applicable to individuals and HUFs. Now, when you talk about businesses or entrepreneurs or any proprietary firm which is trying to save tax under certain expenses, so essentially one is a business expense that you incur, that is the expense that you are incurring for the furtherance of your business. So that is allowed as an expense in a profit and loss account. However, there was a provision for 15,000 rupees that you could pay as a medical expenses reimbursement cost that was allowed as an expense, but that has now been clubbed into standard deduction. So there is no real other expenses that we're looking at exclusively being allowed for businesses. Now, all the provisions, tax deductible provisions that the government provides is essentially to encourage people, one, towards a certain certain saving products, wherein for long term, if you see the 80C benefits, they're essentially derived around the fact that you want to save for your long term needs.
Right.
The 80D, which is a Mediclaim, is to encourage people to buy health cover for themselves so that in case of emergencies they can be used. In case of any other expenses that we spoke about, section 80DD or 80DDB that we were going to talk about, but these are to help and assist individuals who are either disabled themselves or undertaking medication or treatment for critical illnesses. So this is to assist them. So essentially all the tax benefits that we talk about and the government incentives that are given is to either encourage you to save or to assist you for any expenses that you're incurring in your personal in moments of crisis, such as a disability. If you have a dependent who's disabled and you're taking care of them, so there's some tax benefits given to you. Okay. So is the case with critical illness. If you're suffering from a critical illness and you're undergoing treatment, then of course the government is trying to help you with certain deductions. So ideally this is a more of a social welfare kind of an objective and not for businesses to make profit.
Okay. Point noted, Harshvardhan, and I hope and I'm sure in fact most of our viewers out there have been able to get a clear picture as to what are the sections that they could benefit from. But without much ado, let's get on board with our viewer queries. We have first up an email from Kambam Manohar. He says 5 years ago he invested 1.5 lakh rupees in HDFC long-term advantage fund. It is not it's not giving him the return he desired. Wants to understand what he should do, which is the fund that you would advise him at this point of time to invest in place of this one, or should he just withdraw and not do anything and do something else rather with that quantum of money that he has lying with him. He's 64 years old, so one has to keep in mind the age as well.
Yeah, so being a senior citizen, 64 years in age, he's invested 5 years ago into a tax-saving ELSS fund. So HDFC Long-Term Advantage Fund is a tax-saving ELSS fund. Now the idea is, if he does not need money right now, there is no harm in keeping it invested in a tax-saving fund, because now the lock-in period is over. He doesn't 3 years was the lock-in period. Now he can surely redeem if he wishes to, or switch it into another scheme altogether. So ideally, if there is no need for money, let it lie as it is. You may be not happy with the kind of returns that this particular scheme has given, because now I believe it has also been merged with another scheme. So as per your queries also say that it is no more existent. So it's no more existent by itself, but the scheme has been merged into another one, wherein the money that has been invested by you gets transferred into and merged into another existing scheme. So from that aspect, from taxation point of view, the first point is your date of acquisition will be the one which is 5 years ago. Right now there is no tax implication on this merger. Whenever you redeem out of it, whatever the capital gains are there, you will be given a long-term capital gains benefit, because your holding period is more than 5 years. Answering your query whether you should be invested or no, as I said, continue being invested if you don't need the money. If you believe you don't want to be in equities at 64 years of age, you might want to not take risk. So then you can switch into a debt or a balanced fund, or you could move into a complete fixed deposit kind of a product if you wish to. But do not take a decision merely because it has been merged to another scheme. That does not have any bearing on on any taxation or any other perspective for you in that case.
Okay, Mr. Manohar, hope we've been able to address your question and your concerns with respect to the fund that you've invested in. Moving on to query number 2, Kirit Kapadia has written to us as well. He is also a senior citizen with the following breakup of interest income. First up, he has a saving bank interest of about 12,000 rupees. His bank deposit interest is 22,000 rupees. He's a senior citizen, so he has saved in that in the saving scheme 2004 as well. 13,500 is the quantum there. Number 4, interest on company FD NCDs is around 3.5 lakh rupees. Wants to know whether he can get full benefit of 50,000 on 80 TTB or 47,500. So he has a very specific, very pointed question. Harshvardhan, over to you.
Yeah, so if you look at the section 80 TTB, now this allows a senior citizen for exempt income up to ₹50,000 if the interest earned is on the savings account, interest on deposit with post office, banks or cooperative banks. It does not allow for deduction on interest earned on company fixed deposits and NCDs. So in that context, the eligible amount for deduction will be 47,500, which includes only the savings bank interest of 12,000, bank deposit interest of 22, and the senior citizen savings scheme of 13,500. The interest that he's earning on the NCDs or the company fixed deposits will not be qualifying under section 80 TDB.
Okay, there you have it. That's the word coming in on your very specific question. With that, we'll slip into a short break. We have more queries lined up, more insights lined up on the other side. Stay tuned. Welcome back. You're still watching the Money Show right here on ET Now, and we're helping our viewers out to plan their finances, to also plan how to save their money right ahead of the end of the financial year. And keeping it with our viewer queries for now, Rohit Mehta also sent us an email. He wants to understand, is the money spent on furnishing a new house, on things like interiors, furniture, etc., can it be capitalized such that when after 2 years the property is sold out, this expense can be treated as cost of acquisition, indexed, and then the CG computed? Is that a possibility, Harshvardhan?
Yes, if you spent money towards renovating, towards renovation and furnishing your house, you can add that as a cost of improvement. So there are two kinds of expenses. The first one is when you have regular petty expenses such as small plumbing issues and all, those cannot be capitalized. But if there is a major expenditure towards repairs and furnishing your house, it can be added as the cost of improvement, added into the cost of acquisition, indexed, and then of course capital gains benefit can be taken.
Okay. Let's address our last and final viewer query on the show today. Sheetal Verma has also written to us. She's 30 years old. She has availed a loan from her employer for pursuing higher education. Can I claim the interest paid on such loans? That is her question at this point in time. Help her out, Harshvardhan.
Yeah, so Sheetal, the Section 80E is applicable for interest that is taken on education loans from either a financial institution such as a bank, anybody who's regulated under the Banking Regulations Act, or a charitable institution. So in that context, taking a loan from your employer for pursuing higher education, the interest that you pay on that will not qualify for any deduction under Section 80E.
Okay. So those were all the viewer queries that we had on the show, and hope we've been able to adequately address and adequately help you resolve your concerns, your doubts with respect to your investments and your finances. But before we wrap it up, Harshvardhan, you had outlined a lot of options, a lot of ways how one could possibly save up on their tax. But what should individuals keep in mind while investing for tax saving purposes? Are there any do's and don'ts?
Yes, absolutely. So in fact, we are right at that point in time when the financial year is towards the towards its closure, and you will find people frantically running around to save tax. I mean, they would be wanting to invest into certain products so that they can avail the tax benefits. Now, invariably, there is one mistake which is made, which is that your objective of investing is purely on tax saving. So you land up buying a product with an intent to save tax. Now, whether that product is appropriate in your financial plan or no, it usually loses that kind of focus. So always, whenever you're investing any product, just try and evaluate whether would you invest in this product if there was no tax benefit available. So if the answer is no, so if you are not going to invest in this product otherwise, do not invest in it only to save tax, because see, whatever tax you're saving is essentially to an extent of maximum 30%. So 100 rupees that you invest, you will save tax either 10% or 30% depending on your income. So for that 30% tax benefit, you're actually parking 70% of your money in a product which is not going to help you in any way. So that's not the right approach. Ideally, what you should do, identify why are you investing. So if your goal is for long-term retirement savings, for example, and you identify that equity is a good asset class to be in for retirement savings purposes, then choose an equity fund which also qualifies for tax benefit, which is the ELSS funds, the equity linked saving schemes. So your approach will be different. You are investing for retirement and in a product that is appropriate for that goal and also giving you tax benefits. Giving you tax benefits is not the only objective, it is a secondary objective. Similarly, if you are not a risk averse investor, you don't like investing into equities, you are not comfortable, but you have a 5 years and above goal, then you can choose a 5-year bank fixed deposit so that it invests in a product that you are comfortable with. It gives you money after 5 years when you may possibly want to buy a car or use it as a down payment for your house or use it for any other purposes. So essentially, the line of approach is simple. Identify why are you investing that 100 rupees of yours. If you are investing in a product which is only going to give you tax benefits, then you have to evaluate in another form. You have to ask yourself, would you invest in this product if there was no tax benefit available? And if there was no tax benefit available and you're not going to invest in it, then do not invest in it only because it is giving you tax benefit. Because there's other part of your money, you're parking 100% of your money and getting a benefit of only 30%. Now that is a huge burden on the limited resources that all individuals have. So change your approach, and in that way you will be able to also meet your goals and get tax benefits as well. Now this requires some bit of planning. Usually we've always recommended that start your planning from April month, in the month of April itself. You don't have to wait for March, the end of the financial year, to frenetically run around to save, invest in some products. Drop a plan in April itself and then start investing. If you are at this stage where you don't know what you want to do, simple would be to take anything which is non-committed in nature. Do not buy investment oriented policies for 20 years at this juncture, because you don't know whether you want to continue with it or not. If you don't know anything, simply put your money into an NSC or a bank fixed deposit. So at least you're not committed for the rest of the coming years for the same product.
Okay, so the bottom line is be more systematic, plan in advance, and also be more result oriented. What is it that you're looking for from that saving? Don't do it just for the heck of waiving your taxes off or reducing your taxable component that you have to pay in terms of tax. Thank you so much, Harshvardhan. Really appreciate you taking time out and helping us and our viewers out with respect to financial planning. But before we end the show, we have to talk about the biggest story. We have to end, I'm sad to say that, on a somber note, because